I'm really happy to be here. And the topic I've got is tight money timing. Now, that topic comes from a dear old friend of mine, Bill George, who wrote a doctoral thesis on tight money timing back many, many years ago. And he was such a wonderful thinker on the economy and on interest rates and the stock market, and just taught me a lot. And the other important person in my life in this subject is Martin Pring, our very own Martin Pring. And so we want to be sure that we listen to Martin's comments on these things. Okay, so we have just a great interest rate person in Martin, who's right here and available to us. And so we want to pay attention to all of his blogs and webinars on this subject. And I'm going to take a specifically Wyckofian view of the markets here, which Wyckoff called himself a tape reader. And what he meant by that was that he's a chart reader. He uses charts to do his tape reading. And so this is back 120, 130 years ago. So I'm going to look at these subjects today. I'm going to look at the stock market. I'm going to look at interest rates, and we're going to take from the perspective of Mr. Wyckoff, see if we can make some sense out of what's going on here. So I'd like to say that we have a point and figure workshop that we're starting. It's a 3-session workshop that starts today. And it's very special. We don't do these very often. I'm doing it with my teaching partner, Roman Bogomazov. And if you go to his website, wyckoffanalytics.com, you can learn more about it. If you can't attend the sessions live, they will be recorded and available to listen to over and over again. So anyway, I encourage you to go look at that. So let's see. There we go. Okay, so I want to echo, first of all, what Tom said about interest rates in the stock market. I completely agree with everything he said, and I would like to see if I can put a little nuance on what happens with the stock market when interest rates are rising. And the thing is that Bill George taught us is that interest rates really are a function of the economy. And so there are periods of time when the economy is very slow, coming out of recession, in early recovery. We've had a very long period of very slow growth in the economy, and we've had a very accommodative Fed. The Fed has just done, rounds of QE. They've just flooded the market with funds and created very low interest rates with the intention of getting the economy going. Well, it didn't work right away. And so interest rates remain low, historically low, very low. And so the net effect of that is for us as investors is that when you have a slack economy with a lot of capacity in it and interest rates are low, those funds, all those available funds go into stores of wealth. And stores of wealth is the stock market and the bond market, among other things, real estate and so on. And so there's a lot of money out there sloshing around that's available to go into the asset classes that we're very interested in, which is stocks and bonds. And we can see that we've been in a historic bull market where stock prices have been able to go up and up and up. Interest rates have gone down, which has caused bond prices to go up and up and up. And this has been a very virtuous period. Well, all of a sudden we find ourselves with a change of conditions here, which is that we now have an economy that's becoming very hot. So we have an economy that's growing at 4% GDP. Now, what happens is that this is that old saying about when the tide comes in, it lifts all boats. Well, the tide of the economy is coming in, and it's lifting all of the companies in the economy, lifting them up. And simultaneously, they're finding themselves at full capacity, running their businesses. They need to hire more people. They need to build more capacity, and so on and so on. That takes money. And so what they do is they come in, the real economy comes in and competes with the financial economy, which is stocks and bonds, for liquidity. And so when there's competition for liquidity, which is what we're seeing now, interest rates go up. And this becomes and also a store of liquidity is the stock market. So stocks will get sold because there are opportunities in the real economy that people will choose to invest in. And so this creates an economy not unlike we've seen in 2018. And you can see a chart here. This is from a blog I did. You can see the title and the date of the blog when I wrote it. On the bottom, I have that on most of the slides. But you can see that the stock market has really gone into a big trading range with a large decline after a buying climax, which produced a big cascading decline. We've talked about this here repeatedly, so I'm not going to spend any time on it. And these labelings are Wyckofffian labelings, and what we're looking for is the maturity of an accumulation area or a distribution area, with the intention of defining when this area is matured and ready to go into a new trend. So this is what we wrote in this tactical dilemma, is that we wrote that this accumulation period appears to be complete, and we're expecting a good run. In this case, we're looking at the Dow Industrials. And so the Dow was a big laggard compared to the other indexes like the NASDAQ comp because of the FANG stocks and the NASDAQ 100 and the Russell and so on. And we said, hey, the industrials will catch up. And so the thing we'll do is we'll do point and figure analysis to determine the potential for a future move of an accumulation area. And so you can see here that we've taken 3 counts, and these counts are what we call segments. And so we were encouraged because at the point at which we saw the completion of this base, we were able to take a count, a partial count, over to the middle area, which is right here in early May. And we were able to estimate an objective that took us back to the old buying climax highs. And so this is a run up to 26,100 to 26,700. And just yesterday, I think we touched 26,800, fulfilling that count. Now, the good news is this, is that we have higher count potential that we can take 2 additional segments, with the largest count being up to 30,100. And so there's a lot of potential or fuel in the tank for higher prices. The thing that we have to deal with now is we have to deal with the reality of higher interest rates. And so we are going to talk about that in a minute. And so we have touched this. There's 2 forms of resistance that we're seeing here that may cause the stock market, as measured by the Dow, to stop and collect itself. And that is this point and figure count, and also the prior high, buying climax high that was made back in January. And that is a place where investors and traders and institutions are going to remember these high prices and say, this is a good place to sell some stock. That's the condition that creates resistance. And we have resistance here, and I suspect that that's going to cause the market to need a pause for some period of time, and there's no telling how far that is. Well, now bringing this chart up to date, you can see what has happened, and that is we took, this was July 15th, so right about here when we wrote this blog, and you can see what happened after that is, in fact, the Dow Industrials did become important leadership and ran up this trend channel up to these highs right here. And so we have, in effect, fulfilled this first segment of this count. And the important thing is, notice this is very Wyckoffian, is look what happens as the trend matured. you have an acceleration of the Dow into the top of the channel, which is climactic by its nature. And then it came back, it pulled back, and then has gone up to test again. Look at the very high volume here. So this volume is also reflective of climactic action. You can see there's a little gap here. Big wide-ranging bar creates a lot of excitement, and then look at the next bar. Very tight range, very quiet up here, and then it just turns off of that. And now we've had a test, and now we're turning off that test. So interesting place in the market, but we don't think it's we think there's still a lot of potential ahead for stocks in general. It's just that they have to ebb and flow. They go up, they go down, they go sideways, and so on. Now, let's get right into interest rates, because here we have the 10-year Treasury yield. Now, I'm looking at yield here. I'm plotting yield and not plotting price. And so I like to do that. And I think that plotting yield gives us some great perspective about interest rates going up and going down. And the interesting, amazing part of this 10-year Treasury yield chart is look at the Wyckoffean nature of the structure going back to 2008, 2009. This is a huge structure and has all of the elements of a Wyckoffean base. And so the news that I'm here to offer is that, and I've been writing about this actually for a couple of years about interest rates, is that I believe that interest rates are setting up an important base for an accumulation. Now, you have to invert your thinking. An important accumulation for higher prices, and so, or higher yields, let's put it that way. And so now the other thing is that anything that moves up and down, I want to do a point and figure chart on it. And so point figure charts are awesome. I love to look at the market that way, and I've done one here. So, but just to conclude on this yield structure, selling climax, automatic rally, series of secondary tests. This is a little shakeout below the lows of the selling climax, followed by an important rally that goes up to the midpoint of the range. Look what happens. It comes back down, long grinding decline. Notice how this decline takes much longer and is slower than these declines. So this is early evidence of a change of character in the way interest rates are behaving. And look, right at the end, we get a spring, a new low in rates by just a very minor amount, which immediately reverses itself back up. It goes back into the trading range above the selling climax support area, and then comes back after what we call a minor sign of strength, and comes back into what we call last point of support. We talk about this in great detail in our Wednesday Wyckoff market discussion calls and so on, about how to interpret this or how to determine this. But this is a massive change of character. Look at the difference in the behavior of this rally compared to anything that precedes it going back 12 years. So you can see here that all of a sudden you're getting really vibrant rallies, strong rallies, very brief and shallow reactions, strong rallies, and I would suspect that the reaction we get is going to be very shallow, if at all. It might just be a sideways range, and it may come from higher prices. So looking at this point and figure chart, I've just taken the area from here, this area here, which is back at the beginning of 2016, the end of 2015. So it's just this area right in here, and I've counted this. And so you can see that this count goes up to a count, and it says 3150, but that's 3.15% interest rates. So at the time that we wrote this in April, we were seeing 3.15 to 3.35% interest rates. Well, we're now, as of today, with higher rates, we can see here 3.16. So we're now within the bottom area of the estimation of this count. And so wouldn't surprise me if it got to 3.35 before it stopped, which is right around this resistance area. And so just right about there. And so I would expect that at that point, we'll get some kind of a pause for a period of time. So we're pretty close to the highs of these interest rates. And this is because money's tight in many different ways. We have the Fed tightening. We have a strong economy, which is demanding loanable funds. We have foreign investors that are blocked out of buying our bonds because the cost of hedging is so high because money's tight. And so there's all these elements at work that's causing rates to go up. And so, but I think we're very close, somewhere, well, 3.1 and a half, 3.3 and a half, somewhere in there where we're going to get some kind of a stopping action and a pause. Now, the other part of that is that there's much bigger counts that we can take. So now we could count all the way over to here. And so this is a discussion for another day. But keep that in mind. Here's 30-year treasuries. And so this is up through the September 26th. But you can see here, look at the structure. This is back to 2015. So you can see this is weekly, but you can see all the elements are here. Selling climax, automatic rally, spring, minor sign of strength, last point of support, backing up action, and so on. And so this, and look at how this just keeps working higher and wants to get above this resistance area. And we are just on the verge of doing that. So here's a larger point and figure count that we can look at to give us an idea about how high interest rates can go. And so again, I'm not counting the whole thing here, but here's a distribution count missed by one box. That encourages me because that tells me that we can do point and figure work on interest rates, and it can give us good estimates. So, and there's other counts that I've done, but it gives me some confidence that this is a worthwhile exercise. So here we have an accumulation area that we can see in the point and figure work. I put a chart down here, which is through yesterday, which shows the area that we're counting to, which is back into 2014, 2015, right in this area. So we're counting this. And so you can see that there's more to count. And we've only counted the first segment. But look at this first segment. It counts on a 3-box reversal method using standard scaling. It counts up to 5.5 to 6%. And so it gets above the highs that were made back in 2009. And so there's the potential here for rates to go up, and we would expect that in a strong economy, rates can go up. Okay. Now, the thing about rates, before I go to the next slide, is, because I'm going to talk about the dollar for a minute, is that the thing about interest rates going up is that the stock market, if it's a really strong economy will produce higher earnings. And so what will happen is you'll have stocks doing well because their earnings are growing at a fast rate. And so this is what we would expect to see when we have 4% GDP growth in the economy, is we expect that earnings are going to continue to do really well for certain segments of the economy. Other segments maybe not so well because they don't benefit so much from a really strong economy, or they get hurt by high and rising interest rates. But this is generally a good thing, and we can still see that inflation is generally low and not rising, but we're starting to see evidence that the strong economy is causing the raw materials of inflation to start to heat up. So here we can see, this is a blog I did in January. Please take some time and go back and look at the blog and read the notes that I put on the charts. I like to put notes on the charts. And so I encourage you to do that. But at the time, we saw a big completed distribution in the dollar. But we also saw that on a shorter term basis, this downtrend had become oversold below its trend channel twice. And we were of the mind that we could expect a rally in the dollar. And so here is a chart of the dollar up here. with subsequently what happened early January. We did in fact make a low in that oversold condition. We had a good rally, and now we've rallied back up into the area of what I'm calling distribution in the dollar. It may in fact be done. This decline may have completed the decline in the dollar. But I'm going to make the case here that from a tape reading perspective, that I think the rally in the dollar from here up to here is probably done, and that there are conditions and consequences for that. And one of the things I'd like to say about this is that a strong dollar, this dollar rally that we've had, has come with interest rates rising. Usually when you have a strong dollar, it has the effect of moderating interest rate increases, or actually causing rates to decline. But here we're seeing pressure on rates even though the dollar's getting stronger. And so that's kind of an interesting thing. Now, what I've done, because I'm very interested in what's going on with the oil market, and we have talked here about that, and also in other venues like power charting. Please watch power charting. And so here we're looking at crude oil, and so we can see crude oil compared to the dollar. So it's acting pretty normally here. Dollar was extremely strong into a buying climax 2014 and early 2015. Strong dollar, as you would expect, would result in weakening crude oil. Well, crude oil had a big old nasty decline. This was a massive bear market from over 100 down to 26. And so you can see that the strong dollar was very much a negative for crude oil. And look what happened after that. Classic Wyckoffean structure on a very large scale. So while the dollar's in a big trading range, crude oil was in a big trading range with an accumulation orientation. And so this is one of the things that makes me believe the dollar might have the potential to weaken from this area here. So we can see, I have a few more minutes left, we can see this big accumulation, and it's complete. Look, minor sign of strength, last point of support, change of character, rallies up into a sign of strength. And I've written a number of blogs on crude oil, so you can go back and look at these charts. Look what's happened. This is so fascinating to me, and this is the point I want to make, is remember how when we talked about how when we have a strong dollar that we get weak crude oil and other commodities too. Well, look what happened. The dollar continues strong through here, but look what crude oil's done. Crude oil it became choppy and volatile, and I think this is a rising reaccumulation or trading range area. It's just a trading range on a rising basis. But crude oil is rising while the dollar is rising. And so I believe that what that means is that there's latent strength in crude oil that is causing it to go up even on the pricing of a strong currency like the dollar. And so I'm wondering, well, what happens when the dollar stops rising and goes into a trading range? Does this cause crude oil to accelerate faster? Well, so let's have a look at that idea here. Now, this is gold, and what I'd like to do is come back to gold in a minute, if we have time. Now, this is just the rally that we looked at on that really big chart. This is a daily chart, and this is just the rally. It goes back to the beginning of the year. This is the area. Well, look at what's happening to the dollar. The dollar appears to be making some kind of a structure which could either be a pause for a reaccumulation for another move up, or it could be the early stages of distribution or redistribution. And so we're seeing here what we call preliminary supply. You can see that there's a big reaction here with a lot of volume. That tells us that there's sellers starting to come in and sell the dollar in a meaningful way. And when we mean sellers, we mean the really big institutional sellers. And so here there's a buying climax and an automatic reaction. This is what I'm calling it. It's a throw over, big gap here, real climactic structure. The main difference is big volume here, not so big here, and the volume comes in as it starts to break down. So I believe that I'm just going to say that we're in a range bound structure for the time being, that we're going to bounce around and go sideways and be bounded by the buying climax and the automatic reaction for some period of time. And we'll determine later whether or not this is reverting into a reaccumulation or redistribution. Here's crude oil through this whole period. So crude oil has actually accelerated as the dollar has gone into this trading range structure. And so this looks to me like it's crude oil, once it's unleashed from the rising dollar, that it could start to go up faster. And that makes sense because a strong economy, the thing that a strong economy runs on is energy. And so we need energy to be able to fuel the means of production. And so it's natural for crude oil to go up in price as the economy heats up. This is a chart that I published back in November of 2017. And this is two segments. And you can see here that we had a count that goes 94, 97 in segment 1, 109, 115 in segment 2. Well, this was at $57 when we published this, and we can see that we're in the mid to high 70s now. And so here, this is the trading range we just looked at on the daily chart. And I did a point figure chart, two segments of this area on the daily chart. And we have a count 88.93, which very closely matches this. And so that's what we call a reconfirming point and figure count. And then we have a larger count in this area, counts 111, 120, 75, which is very close to this larger count. So this count is confirming, these counts are confirming these counts. And so this gives us a level of confidence. Now, here's the really big structure I showed you earlier. And this, I actually wrote a blog on this, and I guess I didn't put it in here, but I think if you go back to the prior crude oil blog, that there's a link to it. So anyway, you can see here that if we take a larger portion of this accumulation area, the first one we saw, 96, 115, well, if we go over to here, which is this big decline, this one here, the secondary test, this takes us to 174, 193. And right now we say, it's like, well, that's just, we shouldn't expect that. It's just unreasonable. And it could very well be, but it could take years to get there. Point figure can give us projections, and we can see this is a massive base, but it can't tell us how long it will take to do it. But the pressure is on crude oil to go up. And I think that the dollar is ready to stop its rally and go sideways, or maybe even go down a little bit. And there's all this talk about a shortage of dollars for hedging and so on. And that kind of talk, I think, shows up at the end of a move. And we have seen climactic surges in the dollar at the same time we're seeing that kind of talk. The only other thing I'm going to point you to here is there's a blog that I did August 28th on gold, and certainly go back and look at that. This blog has a very long-term chart, and we've just gone down and touched what looks like a last point of support on this very long-term chart, which is exactly touching where the selling climax happened back in 2013. So if the dollar pauses here, it could help gold. But gold is nowhere near as strong as crude oil is. And so we can see here on this daily chart, which is this little decline over here on this monthly, this is monthly bars. And here we have daily bars. You can see oversold, and then comes back in, fulfilled a distributional point and figure count of this area here. And so it appears that we may have exhausted the decline in gold, which may just mean that we're going to have some kind of an accumulation area, and we'll have to judge gold at a later date. So anyway, I think I've just about used up my time. So
yeah, actually, Bruce, that was very, very interesting. And I know I have a question or two, but I think we have one or two in the room. So, Aaron,
sure.
questions.
All righty. So one of the things that they asked was that, so if oil looks like a huge bottoming pattern, is it possible that it's going to make an impulse move at this point? Is that what you're looking at?
Well, so here, just looking at this chart, look at the point figure chart might even be more dramatic here, is notice how we've had this beautiful run up, and also look at these old case studies I did on crude, because there was a big top over here that almost perfectly caught the point figure distribution chart, almost perfectly caught this low. It was quite amazing. But here, notice it's running up and up and up. It's had a backup here. It's jumped out, backed up, paused, and now this chart is, it's gone $10 higher from the point where I constructed this point figure chart. But I would expect that now we're in a position where crude oil could start to have a more meaningful rally phase, which we call phase E, which is the uptrend. And so it appears it's up and out and it wants to have an uptrend. It may have to pause a little more here before it does that. But this is I think it's, from a Wyckofian perspective, very constructive for crude oil. And it's in the context of a very strong economy. So yes, I would agree with that comment.
All right. And then the question is, let's see. So how does the Fed reducing their balance sheet actually impact money being tight?
Oh, that's a really good question. And I don't pretend to be an expert on the Fed, but I think in broad terms, what it means is so they're calling it quantitative tightening. When the Fed basically takes their huge bond portfolio, which they built up in the last 10 years, is quantitative easing was the Fed buying bonds onto their balance sheet. And the effect of buying bonds is that they had to put cash. They have to deliver cash to the banks or whoever's selling them the bonds. And so they are flooding the economy with cash, high-powered money, and they're taking bonds out of the economy. Well, now they're doing the opposite. Quantitative tightening is that I think I've read where it's 50 billion a month now. This is tightening, 50 billion of tightening. They're selling bonds into the marketplace, and they're selling the bonds and they're taking cash. So the buyers of the bonds are delivering cash to the Fed, which takes that high-powered money out of the economy. So it actually has the effect of tightening. And that tightening is one of the forces that's pushing rates up. It's a really good question.
All right, excellent. Let's see. How do you decide whether to use a 1-box or a 3-box reversal P&F chart?
Oh, that's an age-old question, and very good question. And we're going to do a lot of that in our workshop. In our college class, we spent a whole semester just on point and figure. I will give you the also I did a point and figure workshop for StockCharts TV, and it gets replayed from time to time. It's a 2-part special, 2 30-minute parts. And I try to answer some of those questions in there, and maybe we can nudge Zach and Gretchen to maybe put that back on at some point here. But short answer is that we typically do 3-box reversal for larger time periods. So we think a 3-box is like a weekly chart. So notice this example that I have on the screen. Crude oil, vertical chart is a weekly. The chart that matches up, you can see all the major key points on the weekly chart you can see on the point and figure chart, is a 3-box reversal chart that we use to construct that. For shorter term point and figure charts, we do 1 box, which normally we associate with one box with daily vertical charts. Good
All
question.
Right. Yeah, that pretty much covers it. I know, Tom, you had a question.
Yeah, I've got a question myself that I was going to just show you a quick chart and maybe just give you 30 seconds to respond. Maybe it's something we can talk about on another visit of yours.
Sure.
But this is, you know, when you were talking about the dollar going down, I actually share the opposite view. I think the dollar goes higher. And I didn't know if you've seen this chart that I do, just interested in your thoughts. But this is, I always look, when I'm looking at the dollar, I try to look to see what's going on in terms of treasury yields here in the US versus in Germany. There's a number of reasons why I use Germany. I'll skip that for now. But I think what you can see is that this is the difference between the two countries' treasury yields, which is currently rising. And throughout this period, as it's been rising, you can see the dollar tends to kind of follow along with whatever's going on between the treasury yields between US and Germany. And here's the correlation, which shows that it is typically in positive territory, meaning that the dollar does tend to move in the same direction as the difference in the yields. And right now what we see is almost a runaway US Treasury yield versus Germany. And the dollar has been in this uptrend since 2011, if you connect the lows. So I'm viewing this as a much bigger picture uptrend in the dollar. And now that we've turned back up, I'm looking for another push to the upside and eventually challenging the 2016 high. So I don't know if maybe this is a question that's better for a different day, but do you have any thoughts on that?
I do. And my official worldview on the dollar is that it's in a trading range. And so that was that daily chart I put up. I'm saying it's in the early stages of being range bound. And so I don't think that the dollar necessarily goes back down. It's got a lot of resistance overhead. You can see just on the US dollar chart that there's a lot of resistance above where it is right now. But I'm of the mind, and I'm looking at this as being just range bound for the moment because I don't see the evidence of distribution on the daily chart. The other thing, so I'm with you on that because it could resolve itself into a new uptrend. So I wouldn't refute anything you just said. The only other thing that I know or I've heard is that foreign buyers of US treasuries are very frustrated because the tight money environment that we're in is making it very expensive for them to hedge currency. They want to buy US bonds because of the yield, but they don't want to have currency risk in their home domestic currency. So they hedge that risk, and the cost of hedging it is so high now that it's taken away all their yield advantage by buying treasuries. And so it's taken away their appetite to own treasuries or buy more treasuries because the hedging cost has become prohibitive, is what I'm understanding.
Okay, fair enough. Yeah. Maybe this will be a good conversation for another visit when you come back. We'll see what the dollar's doing.
I'd love to.
All right, It's been a pleasure having you on here. It always is, Bruce. Really, thanks a lot. I know our listeners and viewers really love having you on the show from time to time. So hurry back, my friend.
Thank you so much. Thanks to everybody, and we'll see you soon.
With 3 unique service levels and multiple data plans to choose from, StockCharts.com makes it easy to customize your account to best match your specific needs. In this video, we'll help you explore all the benefits of your membership by explaining our service levels, data plans, and pricing. Let's see how it works. To start, you'll want to choose from one of our 3 service levels: Basic, Extra, or Pro. Each service level represents a collection of features and options bundled together. If you're new to StockCharts, our basic service level is a great place to start. At $14.95 per month, Basic will allow you to create larger, more powerful charts and save them to your account. Next up is our Extra service level, the most popular choice among StockCharts users. At $24.95 per month, it includes all the features of our basic level, plus more saved chart storage and the ability to create custom scans and alerts. If you want it all, our Pro service level is for you. At only $39.95 per month, Pro includes even more storage for your saved charts, custom scans and alerts, as well as faster auto refresh, historical data, and much more. For all service levels, you can choose to subscribe on either a monthly or an annual basis. Our monthly renewal option is similar to most other web-based subscription services. You pay for 1 month of service at a time, and your account will simply renew automatically each month. With our annual renewal option, you prepay for 12 months of service and we'll give you the 13th month for free. If at any point you'd like to change your service level or renewal preferences, you can always do so from the Your Account page. Now that you've chosen a service level, let's find a data plan that works best for you. Regardless of service level, all StockCharts accounts come standard with our free data plan, which uses BAT's real-time data for the US and delayed data for all other markets. However, if you want to enhance your StockCharts experience even more, you can customize your account by adding official real-time data plans for one or more of the stock exchanges we support. Similar to exchange fees, prices for each plan vary, as they reflect the fees charged by the exchanges for your use of the real-time data. We want to make sure you have the data that's right for you, so our data plans are flexible and can be added or removed at any time. Keep in mind that all real-time data plans are billed separately from your service level subscription and always on a monthly basis. Unless removed from your account, data plans renew automatically at the end of each billing month. If you do choose to remove a plan, the change will take effect at the end of the month. All data plan charges are non-refundable. To explore all our data plans and update your preferences, visit the Your Account page. StockCharts.com gives you the charting tools and resources you need to invest smarter. And now with the flexibility to customize your service level, renewal cycle, and data plans, we make it easy to find the account options that are just right for you. Take control of your investing in just a few simple clicks with StockCharts.com. Simply the web's best financial charts.
I want to show you a little charting trick that I like to use for the percentage price oscillator, or the PPO. On this SPY chart here, you can see in the indicator windows I've got two PPOs. The first is the traditional PPO. It's the black line there, and that's the difference between the 12-day EMA and the 26-day EMA. And you can see it's above zero when the 12-day EMA is above the 26-day EMA, and below zero when the 12-day EMA moves below. The red line is the signal line, and it's set at 9. So it's a 9-day EMA of the PPO, and you can identify downturns and upturns in the PPO with that EMA. And the histogram is the difference between the PPO and its 9-day EMA there. You can see when the PPO is below its 9-day EMA, the histogram is negative. And then when the PPO is above its 9-day EMA, the histogram is positive. Now, the little trick I want to show you has to do with the PPO 50-200-0. That's the second indicator there. And what I've done is I've eliminated the signal line by putting 0 as that last parameter. So this PPO shows the percentage difference between the 50-day EMA and the 200-day EMA. And you can see that it shows as a histogram when using these parameters, and it has been positive for over 6 months, actually for over a year, actually for over 2 years in this chart. And we can see that it's currently around 3.1% difference. That means the 50-day EMA is 3.1% above the 200-day EMA. And we can confirm that by going to the annotate button there and choosing percentage change. And if you measure the percentage change from that 200-day EMA, the red line, and I go up to the 50-day EMA, there you can see we're about 3.1% difference. And so that's what the PPO is telling you. And so I like to use that longer term PPO to get an idea of the long-term trend.